Hello and welcome to the second part of our personal finance series, which is going to focus on taxes specifically in the United States. So we'll talk about what taxes are, how that money is allocated, how exactly you're being taxed in the different ways that the government taxes you. And then we'll also talk about a case study where we'll go through an individual with a certain set of circumstances and we'll show how their taxes are calculated for each one of the different types of taxes. So with that, go ahead and jump into it. So, first off, what are taxes? And this might be trivial to some of you, but taxes are mandatory payments collected from individuals and corporations by a government entity to fund government activity. And we'll actually talk about on this next slide where that money is actually going. What are the government activities? And some of the biggest items here are defense, so that's our military spending, makes up about 13% of the government tax revenue. Social Security, so this is benefits for children, the disabled, for funding a part of people's retirement funds. Then the health insurance, this would be things like Medicaid and Medicare. And then the other big one is economic security programs. So this is things like tax credits, housing subsidies, food assistance programs, those types of activities as well. And those four really make up the bulk of it, but you can see where the rest of the money's going on these other programs as well. So here's a list of all the taxes the average American has to pay, and a lot of these you might not even realize are taxes. So things like gun ownership fees, highway toll fees, hotel taxes, import taxes. A lot of these end up being hidden, so you really don't realize that you're paying the tax, but they do end up increasing the cost of the goods and services that you're receiving. But today we're actually going to focus on the most common ones that you're probably familiar with. So we'll talk about the different income taxes you pay at the federal, state, and city level. We'll talk about Medicare and Social Security, which combined make up the FICA taxes that you might have heard of before. And then we'll talk about property taxes, so taxes you're paying on the home that you live in. And then we'll talk about sales tax. Not all states have a sales tax. We'll talk about the impact of that on your net income. And we'll also talk about the gas tax, so extra fees you're paying on top of the cost of fuel in order to maintain bridges and roads and other infrastructure that you use to get from A to B. Starting off with federal income tax. So in the United States, this is a graduated, or you might have heard the term progressive, tax rate where depending on how much money you make, you're going to pay a certain income tax on the first part of that money, and then you'll pay another income tax on the next part of that money, and so on and so forth as you work your way up that ladder, that income tax ladder. Then it's also different depending on your filing status. So are you single, you head of household, which head of household here just means that you have a child, but you're not married, but you are the head of that household, so you get a little bit better tax rates in that circumstance. Are you married filing jointly, or are you married filing separately? And you can take a look at your filing status and your income to understand where is your money actually being taxed and at which different brackets. The state income side, it can be varied depending on the state that you live in. So some states, such as Florida and Texas, don't have an income tax at all. So that's why you've seen recently a lot of people moving to those states because they're able to hang on to a lot more of their earned income. There's states that have a fixed income tax rate, so that's just a flat percent that's applied across all income levels. So whether you make 10 grand or 100 grand, you're going to pay the same, say 3% tax on that income. And then some states have a variable income tax, and this is the exact same thing as the graduated or progressive rate that we talked about at the federal level. So the more you earn, the higher tax bracket you actually fall into. On the city income tax side, and again here, just like states, not all cities have an income tax, but ones that do, it typically falls into these two buckets we talk about below, which are work city, which you must always pay the income tax in the work city you live in first. And then some resident cities will give you a credit rate that says, hey, if you are paying a work city already, we're going to recognize a portion of that to reduce your resident city tax bill. Just to look at a quick example, if your work city tax is 2.5% and your credit rate is 50%, and your resident city tax is 1.5%, you're going to first pay 2.5% to your work city. Then your resident city is going to recognize half of that, or 1.25%. So you're actually only going to pay your resident city 0.25%. In total, coming to 2.75% of city income tax. And next, we'll talk about the FICA taxes. This just stands for the Federal Insurance Contributions Act. So this is something that you're paying into throughout your career, whether you're employed or self-employed. And this is meant to fund benefits such as for retirees, for their retirement income, as well as medical insurance throughout retirement, the disabled, and then also for children. And there's really two components that make this up. There's Social Security, that is 12.4% of your income, and then Medicare is 2.9%, totaling 15.3% total. So a pretty significant tax. If you are an employee, though, the employee pays one half of that, and then the employer pays the other half. So you as an employer are going to pay 7.15%, and the employer is going to pay 7.15% as well. If you happen to be self-employed, then you actually end up paying a self-employment tax, and all that self-employment tax actually is you're paying the other half that the employer would typically have paid. And there is an income limit on FICA, so if you earn over $147,000, you actually stop paying this tax. So as you get above $147,000, your tax rate on those additional dollars actually goes down. And then property tax or real estate tax. For this one, there's three factors that really go into calculating the property tax amount. There's the tax rate, and this can be made up of multiple different taxing authorities. I believe in the county I live in, there's 76 different taxing authorities that can actually tax your property. This could be things like the township, the county, school districts, public parks. There's any number of things that of authorities that could put something on the ballot to levy additional taxes on your property. There's an assessment ratio, so you'll have a certain percent of your property is actually taxable, not typically 100%. And then you'll have your property value, so what's the fair market value for your property? And just go through an example. Say your tax rate is 5%, the assessment ratio is 35% of your property's value, and your property is worth $400,000. In this case, you'd have $400,000 times that 35%, times the 5% tax rate, and it would be $7,000 per year. If you're interested in looking for this information on your home or other homes that you're interested in purchasing, you can go to the local county auditor's website, and you should be able to search in the address you're interested in, and then it'll tell you what the actual tax rate is and what the property taxes were going back in time. And then for sales tax, you can see here the more darker blue is a lower state sales tax until you get the orange and the red, and those are higher state sales tax. You can just find your state on there to see what the average sales tax is. And keep in mind, these are combined state and local. State, for example, Ohio has 5.75%, but then there's also an additional county tax depending on where you're purchasing the goods or services. And then for the gas tax, the federal gas tax is 18.4 cents, and then there's also typically an additional state tax that goes on top of that as well. So if we just look at one of these, for example, Ohio has the federal tax of 18.4%, 18.4 cents, and then they also tax an additional 38.5 cents per gallon. So if gas actually was only sold at $2, you would actually be paying $2 plus 18 cents plus another 38 cents for what you'll actually pay. And this is one that's kind of hidden and people don't even realize that they're paying. But every time you buy a gallon of gas, you're actually paying an additional tax to maintain the roads and bridges and so on. And next, we'll go into a case study. We'll look at an individual with a certain set of circumstances, and then we'll go through each one of those different taxes and calculate out what that person would be paying for those taxes. And in this case study, we'll go through John Smith's life. He's got no children. He's single. He's an employee for a company who makes $100,000 a year salary, so a pretty significant salary. And as we go through this example, you'll see how $100,000 actually doesn't amount to much actual net take-home pay after you factor in all the taxes that this individual would end up paying. And we'll say that they work in Brecksville, Ohio. They live in Cleveland Heights, Ohio. Their home they live in is worth $400,000, and each year they spend $25,000 on expenses that are taxable at a sales tax level, and they drive about 12,000 miles a year. So next we'll go through line by line all of these different taxes, and we'll show how they're actually calculated for our buddy John here. So his gross income, as mentioned, is $100,000 a year, but actually everybody in the United States, it's different if you're single versus married, but for single in 2022, it's about $13,000. So we need to subtract that from his gross income to understand his taxable income. So with that, we're just going to go through each one of these different brackets. So the first $10,275 is going to be taxed at 10%. And then the next $31,500 is going to be taxed at 12%. And then the final amount is going to be taxed at 22%. So $45,000, 274 is going to be taxed at 22%. And that grand total actually comes out to about $15,000 is going to pay to the federal government as an income tax. So we'll populate that in our table over here. And then the state income tax for Ohio. These are Ohio's tax brackets for an individual that's single. Same idea here. The first $25,000 is taxed at a 0% income tax rate. The next $19,000, roughly $19,000, is taxed at 2.765%, and then the final $43,000 is taxed at 3.226%. So we'll end up paying Ohio about $1,900 as a state income tax. For a city income taxes, Brecksville has an income tax rate of 2%. Cleveland Heights has a tax rate of 2.25%. And Cleveland Heights also will give you a 50% credit rate up to 1% of what you're paying in your work city. So showing that calculated out, Brecksville would just be 2% flat of that $100,000. Brecksville does not give you the standard deduction like you would get for your federal and the state level. So that's going to be $2,000, easy calculation there. And then Cleveland Heights is going to subtract out 50% of that 2%, which would be 1%. So that's lower than the 1% limit, so you can take that full 1% deduction. So you're actually going to do $100,000 times 2.25 minus 1, or 1.25, to get $1,250 that you'd be paying to Cleveland Heights. So in total, you're going to be paying about $3,250 to your cities between your work and residence city. And then for the FICA taxes, the employee half here is going to be $100,000 times the 1.45%. Social Security will be $100,000 times 6.2%. For the employee total to be about $7,600. Then the employer is going to pay the other half of that. There's an important note to make here, and you'll see this in the final calculations, is your total compensation isn't actually $100,000. It's $107,650 because even though you're never seeing that money, it's going into the total compensation that your employer is paying for you. So if this tax didn't exist, it's feasible to say the employer would actually pay you $107,000 salary because they don't have this additional expense. So that's why that ends up getting added into your salary for the final calculation. And we'll see that at the end. For your property taxes, in Cleveland Heights, Ohio, the tax rate is 8.812%. The assessment ratio in Ohio is 35%, and the property value, as we mentioned, was $400,000. So his property taxes per year are going to be roughly $12,300. So another pretty significant chunk there as well. In sales tax, in Ohio, the state sales tax is 5.75%, and then Cuyahoga County, which is the county that Cleveland Heights sits in, also levies an additional 2.25%. So anything that you purchase that qualifies for a sales tax is going to be taxed at 8%. And as we mentioned, John has about $25,000 of taxable expenses per year, which comes out to another $2,000 in taxes that he'll be paying on goods and services that he's purchasing. And then for the last one, for the gas tax, the federal gas tax, as mentioned, was 18.4 cents. Ohio's gas tax is 38.5 cents. So you're paying 56.9 cents per gallon of just taxes. And we said that he drives 12,000 miles per year. The average miles per gallon on a vehicle is 25 miles per gallon. So it comes to about 480 gallons per year that he's purchasing, multiplied by that gas tax. And he's actually paying an extra $273 in gas tax per year. So lastly, we'll take a look at John's final tax summary. We talked about his gross salary of $100,000. Then we need to add in the employer portion of the FICA taxes of $76.50 to get to his total wages and compensation of $107,650. And then we need to add up all the different taxes that we just went through, from federal income tax all the way down to that gas tax. And those total up to be $49,841. So really an astonishing amount of money that this individual has paid to taxes from his overall earned income. And just to calculate out that effective tax rate, that 49,000 divided by the 107, comes to 46.3% of his earnings end up being paid to taxes in some form or another. And you got to remember, this doesn't include all the other minor taxes we talked about earlier. So the highway toll fees, parking fees, things like going to a public park, all the different things, the licenses you pay for, renewing your license every year, professional licenses, all those things are considered taxes and aren't accounted for in this number. So really this individual is paying probably more close to half or maybe even more than half of their money that they earn in taxes to the government. So I'll leave you with a couple of final thoughts. And you may have heard this wisdom before, but your biggest expense in life, it's not going to be expensive vacations. It's not going to be fancy cars. It's not going to be your dream house. The biggest expense in your life will very likely be taxes. And I think that's kind of evidenced by everything we just went through, showing the significant number of taxes and then the amount of dollars you're paying to each of those different taxes. So that's why it's really critical to learn to minimize your taxes legally if you really want to get to financial freedom someday. The more of your earned money that you can keep, the quicker you're going to get to your financial goals. We won't go through it in this video, but in future videos, we'll talk about different strategies for reducing your taxes, different credits you might be able to apply for, and then also different ways to invest and allocate your money to legally reduce the amount of taxes that you're paying. So you definitely want to stay tuned for those as well. With that, thanks for hanging around for the full video. I just want to say thank you for watching. If you got value from this video, please go ahead and hit the like button below. If you want to be notified as more videos in this series come out, make sure to go ahead and subscribe. And if there's anyone in your life, friends or family, whoever it may be, that you think would get value from this information, please go ahead and share this video with them, share it to your social, whatever it may be. I would greatly appreciate that. All right, thanks again, and we'll see you on this next one.